It all calls into question why a demonetization episode was accompanied by the introduction of 2,000 rupee notes to start with. Just looking at how food prices have become less volatile over the last, 7-8 years, I would think FCI is probably doing a better job. I think the Indian story really is within group inequality possibly has widened, but between group inequality has shrunk.
Hello everyone, welcome to Arth Niti. I'm Shekhar Tomar. We are extremely happy to have Professor Amartya Lahiri with us today. He's currently Professor of Economics at University of British Columbia. Prior to that, he has also worked at University of California, Los Angeles. He's also worked at the Fed at New York, and also CAFRL, a think tank associated with the Reserve Bank of India. His research work is primarily on international economics, growth, and development economics. He has published a lot of very well-cited papers in the field of inflation stabilization programs, currency management, as well as understanding the gaps in terms of productivity and income within the country and across countries. We are extremely happy to have you, Amartya, here. Thank you for your time and welcome to ArthNiti.
Thanks for having me. It's a pleasure being here.
So I'll start with the first question, which is something happening in the recent period, which is the things that are happening with the rupees 2000 note. So what are your views on it? And if I may use a strong word, is it a soft demonetization again?
This one's a bit different in the sense that this was not, it has continued to remain legal tender. It's not been demonetized in that sense. It's like people have been given a window with which to convert them. This is not that unusual. Countries have gone through for different reasons. The UK did it. I remember getting caught in London a couple of years ago, actually last year, when I had some old, 20-pound note and tried to use it, and they said, it's been, you have to go to a bank to convert it. So those countries, Canada went through the same thing of phasing out paper notes and switching to...
But that's usual, no? Or do you have to make a declaration about it? I'm sure.
No, the key difference, though, is that, in some sense, the difference between the demonetization episode we went through in 2016 versus this one is that it's not been demonetized in the sense that it's not legal tender or anything. It's just been said that it'll be phased out. You have time till 30th September to exchange this and after that, it's a bit unclear what will be the state. So that there's a little communication issue there, but it's not like this overnight demonetization that this is no longer valid tender and now you have to go and convert it and line up in your bank, and which was a whole different order of magnitude. The other comparison is other countries have done similar things when they're trying to phase out paper notes and convert to plastic and so on, which is what happened in Canada and the UK. There too, people were given some time to convert them, and it continued to be legal tender for a while. And once that, sunset date came and went, after that you had to go, it was no longer legal tender. You had to go to a bank to convert it. People wouldn't accept it because it was no longer. So in that sense, demonetization, the way we think of it is really when overnight you say, it's not going to be exchangeable anymore. And there were prior histories of those in India as well, when it was really an attempt to sort of achieve something else. Not so much just phasing out one currency, one bill of tender versus the other. There is, of course, this related question of why did they want to do it? Which is, so there are all kinds of...
But if I may continue on it, so maybe it's not even soft demonetization. Maybe it varies, and some other countries have implemented it, but it's still around 10% of the currency in circulation.
Yeah.
So is there going to be any effect that we can think of, or it's very minor relative to what we had in 2016?
Yeah, I don't think this should have any effect, frankly, because first up, people can exchange them for, in 500 and lower denominational currency. So it's not as if money is just overnight going out of circulation, which was what had happened the last time. And moreover, the rest is just being put back into the bank as deposits. So in some sense, nothing's going on with money supply as defined by M1, right? That we still have. So the big problem is if it ceases to be legal tender, and then you have an economy which relies on cash for transactions suddenly missing cash, then you have a bigger problem. that is, people weren't really using. I mean, those. I mean, when I come to India like 3 or 4 times a year, and I think for the last 3 times, I don't think I've ever used a 2,000 rupee note, because if you tried to use it, people would say, I don't have change, or they were very. It was very, people were very reluctant to use it. Of course, it all calls into question why a demonetization episode was accompanied by the introduction of 2,000 rupee notes to start with. And so that's a whole different question about why these notes were introduced when the goal of the initial demonetization effort in 2016 itself was to sort of make it more difficult for people to keep save in terms of big denominational bills. And so that's why the 1,000 was demonetized, and yet we introduced 2,000 in exchange. So you can view it 2 ways. One is to say that it was just happenstance, that there was a plan for 2,000 introductions.
I mean, there was some practical aspects of it because you wanted to reintroduce very quickly.
Yeah.
So probably you had to introduce it.
But I guess it does raise the question of why was it so easy to print 2,000 as opposed to 500? No,
it wasn't just the printing issue, right? You had to also put it in the ATM, and then it makes
absolutely.
it easy.
So I guess the question was, there were plans for 2,000s already in place, which was I think there is a view. I'm not an RBI insider, but there is one school of thought which says there was a plan for 2,000 introductions.
You're kind of RBI insider around that point of time.
No,
officially no.
Yeah, I do not. So I'm not going to say anything about whether this was actually. I'm just conjecturing that the speed with which the reason that the easiest, as you said, we had to introduce something.
Yes.
And the only thing they could find was 2,000 rupee notes, miraculously, which showed up within like a month. Or within 15 days of this announcement, there were 2,000s available in somewhat copious supply, whereas you had very few of the 500. And so that suggests that these 2,000s were probably, for whatever reason, there was a plan to introduce them. And so these were there, and these were the ones that were introduced, but which kind of flew in the face of saying that we're trying to demonetize 1,000 rupee notes because people are using this to hoard undeclared income. But then why would you introduce 2,000? So maybe this is a sort of an ex post way of undoing it. You don't want to do it within 6 months of having introduced it, then you don't look very good. So, I mean, you kind of do it, give it sufficient time. I mean, 6 years.
So let's go back in time, and you mentioned M1, that's not going to be impacted this time. So I want to be super neutral, and I know you did a research paper on this, just looking at the 2016 episode in India on demonetization. If you're very neutral, can you tell us some of the positive and the negative aspects of it?
So the negative aspects, I guess everybody in India lived the negative aspects. So I don't think we need to keep...
I'm not sure if everyone believes that, though. They thought it was still positive. But
no, so I think there are 2 sides. I mean, there's a question about what happened on the net. Was it positives outweighed the negatives or the other way?
Yeah.
So in some sense, negatives, everybody lived through the negatives about what happened. So, the disruption that it caused to people individually, to the informal sector, which was more reliant on cash and so on. So those, I think, have been talked about quite a bit. The flip side is the arguments that were, somewhat ex post rationalization for this, because, as you know, when the episode happened.
So let me take a step back, even ex post rationalization, let's do ex ante. Is there anything positive that can come out of such an episode?
Well, I think a lot of these, let me answer it in a different way. So, ex ante, when the policy was announced, demonetization, there were certain goals that were articulated by the Prime Minister. Those goals were then changed. It was like a changing goalpost a little bit as days went by. Initially it was black money and counterfeit. Then, we added in digitization. Then there was this formalization. So those things were the last 2 were kind of added as we went on. And those 2 goals are the ones that now people kind of talk about much more. I mean, because the first 2 were clearly based on what came back. Pretty much all, almost 100% was returned to the banking system. So it was not like ill-gotten gains just got wiped off the face. People were able to exchange them. And second, counterfeit has always been, a very, very small part of the overall money in circulation as far as what estimates we have for it. So those two goals were really, not, I think, serious goals in some sense. But the second, the third and the fourth, which is the digitization of the economy, and that it was going to force people to adopt, to rely less on cash and more into, it's going to spur some technological change and induce digitization. And second, it'll force people to go through formal banking structures, which would imply a greater formalization of the economy. Those two are sort of, good goals, and I think there's been some success there. For sure, that digitization has improved and increased in India, and formalization is also, increasing. There's much more. The soft infrastructure that we have has become more widespread in terms of tracking people within the country, and a lot of that is because banks have become more a bigger player than they used to be, and so it helps in the formalization of the economy. So I think those two goals are good goals to digitize an economy and to formalize the economy. I think.
So should I take it the change of goalpost as saying the first two ones, which is black money and the counterfeit, they were kind of not achieved? And so,
I think we can sort of rest the case on that. I mean, those I think were just. Those were goals that were just articulated.
And if we talk about the later two, like how big is the impact?
Yeah, so here there is. I mean, we have research papers which have been trying to see if there is evidence of clearly the thing with digitization is there's a trend that this was as an economy grows and develops, there is this. Improvement in increase in digitization that happens, and so a lot of the economies around the world have, there is digitization that has been growing over time. Formalization is also a coincident characteristic of an economy as it develops, so this is going to be part of it. Did this create jumpstart some of those? I think some of the experiments that I've seen that people have looked at, whether the distribution of cash across sectors that were, the distribution, the extent of the demonetization was dependent on where the cash terminals are and so on. And so people have looked at those variations of those to see if digitization was greater in areas where they were worse affected in terms of cash and so on. And there is some evidence that seems to have happened. Certainly in the cities, I do see a distinct, a very sharp uptick in how people have embraced digital payments. I mean, there's no doubt. Relative to 2016, there is a much bigger interface with digital payments. I mean, it's widespread. All kinds of payment systems and payment portals are being used. Cash. But that said, India still is massively rural. And so the question that I haven't adequately seen an answer to is this uptick in digitization, the distribution of this? I'm not completely convinced that it has spread far and wide into rural India. From what little I've seen, I haven't seen, as I'll be the first to admit that I haven't gone over all across rural India. I've seen a little bit of rural Bengal. And digital payments are not as, clearly haven't taken off as they have in now other states in India. But the flip side of it is that, the M1 to GDP ratio has been back to where it used to be.
But before we go there, I know your survey paper talks about it, and there has been some other studies as well. The negative impact was not so long, hardly for a quarter or two, although it can be 2 quarters bad GDP growth is bad as well.
Yeah.
So if I have to think about economically, why it should have gone down, the economic growth, and if you can also talk about why it only lasted this bad impact for only 2 quarters, because people were worried that it would last for much longer.
Yeah, so the economic impact in some sense is, disproportionately distributed towards the informal sector, and that was the major concern, that it was going to, create long-lasting damage. And so clearly the fact that there was a major disruption is not up for dispute. The question is, how come the economy made a comeback? Now, you can view it in two ways. You can view it to say that the informal, economy kind of just recovered. I mean, once the cash was reintroduced, things kind of went back to the way it was. One also has to remember that there was another, change that came in pretty much, a few months after demonetization, which was GST. Now, GST had a lot of the same drivers on the informal sector. So some of this digitized interface, some of this formalization, which now we like to hang all on demonetization, had a lot to do with also this the GST reform that came in, which was I think June of 2017,
July 2017,
which is when that was introduced. Those were precisely to formalize a lot of the economy. So. I think it would be somewhat naive to attribute all of the, whatever we are seeing in formalization to demonetization. It had, GST had a much bigger role to play over there. In terms of how come the recovery was relatively quick, and I think that's just the resilience of the informal sector. People, if you are not able to, in the informal sector, there's very little, absorptive capacity. I mean, you have to recover and so in some sense, what it says is the remonetization was done in 6 months. And that's about the length of the disruption we had. Once it was remonetized, it was like back to normal. Then it begs the question of what did we achieve with all of that? So it has to come back to this question of what did it do to lives for 6 months versus did we achieve any long-term gains? So as I said, the long-term gains are really being split between arguments that we have managed to digitize payments a bit faster than we would have digitized otherwise. And the second is the formalization. The formalization, I think, has much more to do with GST, whatever has happened, than demonetization.
Are there any papers which also talk about the cost of just standing in the queues? There are, as economists, we want to look at the other side as well, the opportunity cost. In this case, you're just queuing.
Yeah, it was queuing. I actually haven't done this, but in terms of it would require surveys of people, who conducted surveys at the time as to how much time was being spent just standing around. But the loss in GDP is a measure for all of that. Of course, our GDP measures at that time became a little strange because, it's the nature of GDP measurements that we end up estimating what the informal sector is doing based on extrapolating from what the formal sector is doing. And this was a particularly bad time to use that because this shock was disproportionately hitting the informal sector. So as a result, to try and figure out from what the formal sector was doing, try to use that to estimate what the informal sector was doing would give you a particularly bad estimate of the economy. So I think whatever shock was measured was an underestimate. I mean, it should be, I think the shock would be much bigger. It would be just the nature of GDP estimation in India would underestimate it. I think that I think, one should pretty strongly be able to assert that.
So you're saying that using these aggregate indicators, let's say the growth fall was 2%.
Yeah, it would be much bigger.
It would be much bigger.
Yeah, because we are estimating that of formal sector movements. We are trying to extrapolate.
So this is the time period when these two sectors were decoupled in some sense.
Yeah, because the shock was very disproportionately on the informal sector. GST was very similar as well. So that is a period when our estimates, I think, are underestimating the negative shock. So the shocks were, I think, bigger than that.
So if you have to conclude the positives and the negative, I know it's very difficult to come up with a number.
Yeah. No,
would you do it again?
Giving a number, I would not have done it then. I would not do it again. I think this is all a cost-benefit story. This notion of formalization, it was happening anyway. GST was going to do most of the action.
So I haven't surveyed economists, but if you survey, let's say 100, how many would say, it's a good exercise to do?
Good exercise? I mean, demonetization.
Demonetization.
I'd be surprised if you would find more than 15% who would say.
That's a big number.
Yeah, I'm being charitable. I would think it should be probably less than that, but it would be hard to find people who would, economists who would say that this was a good thing.
So just a follow-up question, and this is the last question on demonetization. When you were doing this survey and looking at other papers, is there any other similar example in other countries where we can draw some
Not at this
findings from?
scale. Not at this scale. This was the scale of it was just astounding that one would do this at this scale in an overnight way. It's hard to find a parallel for that. I mean, people have done demonetization exercises in other places, but India in particular has done it multiple times. But what typically doesn't happen is demonetizing over 80% or over 85%. It was 86% of the people demonetized because of concerns about, large savings being held in cash with unaccounted income and so on and so forth. So the standard approach is to demonetize really large denomination bills. India had done this in the past. Other countries have done this in the past. To demonetize bills that people use for regular transactions, that is somewhat very unusual so I think, frankly, if India had demonetized using only the 1,000 rupee ones, it would have not created anywhere close to this kind of debate, concerns, effects, because even 1,000 rupee notes were not being used quite as much for transactional purposes. It was really 500 was the bread and butter. So, if you left the 500 alone, just demonetize 1,000, I think a lot of the same arguments could have been made without the associated disruptions. And I don't think it would have created. You and I could have had an argument about it, but
that's it.
But that's it. But I think what becomes problematic is to say that I'm going to take what people use for transactions. It is not, because you can say cash is used for multiple reasons, for transactional purposes, but I only want people to use it for transactions, not to start hoarding income. But then demonetize what people would use to hoard income. 500 no one's using to hoard income. It would be kind of weird for somebody to use 500, So that part of it just revealed some, maybe hadn't been thought through properly. I don't know what the thinking was. It was just poorly done. And then the ex post rationalization then is sort of ignoring the fact that what you said then about what you wanted to do, demonetizing 500 rupee notes wasn't going to create any of these other benefits that you wanted. So I think that was the bigger mistake. I think 1,000 rupee note demonetization, people would not.
No one would have noticed it.
Yeah, it wouldn't have created this kind of disruption.
So moving from demonetization, I mean, you have worked on monetary policy in India. You also worked in the Fed in New York. So you have very wide experience. I'm reading from one of your articles. So you mentioned that current monetary policy appears to be based on a routine application of developed country principles to the Indian context, a leap that may well be completely misplaced. So can you tell us a little bit more about it? That what is this difference between conducting monetary policy in the US versus, let's say, in India?
Yeah, so I think the big thing is monetary policy works, through a couple of channels. One is this idea that somehow there is some things don't move all the time. They're kind of predetermined. So if you inject some cash, somehow you generate more liquidity in the system, there is more cash circulating, it'll create its own demand because some things are not moving. So you might say prices are not moving. Maybe that's one of the things that makes liquidity injection creates real effect. So a lot of the thinking in developed countries is based on that kind of work. So if you think about output just being decomposed into pieces of who is demanding that output, whatever we produce. So we produce what's being demanded, and sometimes we produce more than what's being demanded. Sometimes the country produces a bit less. So, but there has to be overall some match between what's being demanded and what's being produced. So our demand, you think of this as aggregate demand is really what's being managed through monetary policy. Those have really two big components to aggregate demand. There is consumption demand that individuals and businesses and households have, and then there is this investment demand, and so monetary policy is really targeting those two things. Indirectly, sometimes it targets the net export side in as much as it affects exchange rates and so on. But Government spending, which is the other big component of aggregate demand, is really the domain of fiscal policy. It doesn't come under monetary policy. So what the government is, what monetary policy tries to do is affect consumption or investment. That consumption demand is often based on my purchasing power. So if I get somehow more purchasing power, I might want to consume more. That additional purchasing power, in turn, is what liquidity is trying to create. So if I inject liquidity, for some reason, if prices don't respond, if there's 5% more liquidity in the system, but prices are not rising at the same rate, we have some increases in our purchasing power, and that's what shows up in consumption demand. The other part is what are firms and businesses doing. Now, most of the time, what people are varying, as policy levers are these interest rates. So now think about from a consumption side, by the time all of this interest rate changes translate into liquidity, which translates into effective demand on the consumption basis for individuals, is a mechanism that is barely there in India. It is there much more because people use, there is a mapping from interest rates to consumption in a much more, straightforward way in industrial countries, simply because there is a lot more use of, the interest rate is a well-defined price of consumption because people are borrowing and lending all the time, so financial markets are much more developed. And as a result, consumption decisions, whether you're using credit cards to do this, whether you're borrowing through, credit in advance or lending lines from your banks, those interest rates become a key component of consumption decisions. So anytime interest rate changes, people are taking out equity lines from their housing, whether they're, choosing to buy more durable goods when interest rates drop, because, suddenly the cost of credit has gone down. You can take out an equity line from your house. But those things don't operate in India. It's like a very consumption is still very cash dependent on overall.
So in the US, maybe you'll swipe your credit card. Here, maybe you'll ask your family.
Yeah, you'll ask your family. Most people are really going still to this day, independent of what we say. Most consumption demand is really going from cash to goods and goods to cash. I mean, that's really the conduit. And some amount is put away as savings, and so there's a little bit of what's going on.
But businesses would be more...
Yeah, so then that comes to the second part, so investment. So what we really have when we are playing with this interest rate policy is really credit policy. That's what we are trying to play with. It's the mapping from interest rates to investment. And that's our credit policy. We don't really have monetary policy in that sense. It's really, one should call it credit policy. That's what India has, because the mapping to consumption is weak at best. So then, but we continue. Credit policy doesn't necessarily work the same with the same frictions. The idea that we have that why does monetary policy work? Well, because prices are sticky. That's a very consumption-oriented idea. And those things work in the West to some extent, simply because even there is debate. How much is the effect of monetary policy? And so I'll come to that. How effective is the monetary policy transmission in some sense. But conceptually, the idea is people have spent a lot of time trying to measure how sticky our prices is, our prices moving or not, and then what is the implication. So using those estimates. So people spend their careers doing this, trying to. Why? Because that's the structure of monetary policy that they're pursuing. What is also well known is that prices tend to be way more flexible.
I remember we did some work on it together.
Yeah, we did some. So prices tend to be way more flexible in countries like ours, as opposed to the West, where inflation is traditionally much lower. So a lot of contracts are long-lived. Prices tend to be stickier because prices don't really change. Overall inflation isn't changing, so individual producers don't feel the need to have to change it all the time. Here, nobody will want to get stuck with a one-year contract, because except the wage earners like you, who are probably stuck with one-year contracts. But the remainder, they just go with very short-term contracts. So prices move, as we found. They were moving day to day. At least in the grocery segment, it was working. And it is true in general. Prices move much more in developing countries than they do in developed countries. So therefore, to conduct monetary policy based on a perspective which is very, very based on consumption, transmission of monetary policy, is missing half of it. Because here it's really what matters is credit policy. And so there you have to now worry about how much a bank's transmitting of this to the end consumer, to the end borrower, which is firms. And that is the main thing but credit policy can work independent of stickiness of prices. But what we are using as a framework to do all of this is not so much we have the same sticky price, kind of perspective of what monetary policy injections are doing.
So it's not going to transmit in the same way, but we are also using inflation targeting on top of that now.
Yeah.
So where does that bring in?
So inflation targeting can be rationalized independently, right? I mean, inflation targeting can be rationalized independently for the simple reason that price setting needs anchors. When anyone is setting prices, if I'm running a business, if I'm trying to set a price, I need to have some projection about where, aggregate prices are going to be, how they're going to be changing. Because that is my anchor, so that I decide my sort of relative price based on that. Because I'm trying to figure out what price should I set for the next year based on how I think aggregate prices are going to move. That requires some kind of anchor. And there is this, little bit of indeterminacy there in the sense that, if I don't have an anchor, this inflation expectations can be going all over the place. So inflation targeting sets a little bit of an anchor that, everybody understands this is what the central bank is trying to deliver.
So if we ask, inflation expectation survey have been done in the US as well. And over there as well, you always find that consumers are reporting anything under the sky.
Oh, yeah.
Firms are reporting, firm managers who should be better informed, they are reporting anything under the sky. In India, RBI has a target of 4%. I'm sure if you go out on the street, almost no one would know what the target is.
So, okay, so I'll come back to the Indian case in just a bit. So what happens outside, at least in terms of the inflation expectations? So you can look at it from firms. I've just done some recent work on this. That's why I know a little bit about this. And there are household expectations. So, what ends up happening is short-term expectations, which are like these 3 months, 6 month, 1 year, they're very highly correlated with current expectation, current inflation. So as these things move, what matters though, but when you look long-term expectations about 2 years out, 3 years out, those things are remarkably, flat around that, announced Fed target of 2%.
So the anchoring you want is for the long run?
Yeah, for the long term, because that's the planning horizon that people often, when they're putting in place business plans and so on, the horizon is really that. The short horizon stuff can become much more volatile based on what's going on, which is why this current episode was a bit destabilizing, because what we've had in the West for the last 20, 25 years is we haven't had sustained deviations from the inflation target for anything more than 8 quarters. So it would typically go up and it would fluctuate around, drift up, come down, drift up, come down, around that 2% target. What happened over the last, since 2022, early 2022, or late 2021, was that these deviations from target, persisted for 6, 8, 10 months, and that's when you start seeing these expectations, deviations beginning to kind of really, take off, and that's why all these central banks, which initially responded by saying that, oh, these are just temporary shocks, we're not going to respond. The belief being that inflation expectations are anchored. The long run, if it's a temporary shock, it's all going to come down anyway. I'm thinking it's supply shocks hitting the economy. The Ukraine war has disrupted food and all of that is going to somehow take care of itself and it's all going to come down. And so these inflation, which responds in the short term, the inflation expectations are respond, but it's going to go away because inflation, the original driver of inflation is going to kind of go away. But when that didn't happen, in other words, the supply shocks were much more persistent than the people were expecting. They did a rapid pivot. And when they pivoted, the argument was precisely this, that inflation expectations are at danger of becoming unanchored. And that was the major concern.
So I'll ask a question. This is more opinion over here. Like the market was kind of factoring that long-run expectations have changed now. Do you think Fed was a bit behind the curve on this?
Maybe. I think they could have. I mean, there was a little bit of two things going on at the same time. One was how much of this was supply driven and how much of this is demand driven. Now, as we were discussing earlier, monetary policy is in the business of managing demand. It's a demand side instrument. It really can't impact long run supply conditions. So supply shocks, we have a much harder time using monetary policy to do, except for if somehow the supply shocks become so long-running that they start causing inflation expectations to become unanchored. Then you have to somehow do something to try and prevent that from happening. Otherwise, all you're trying to do is manage. You should respond to demand-side shocks, but you should kind of stand still if it's just supply-side disturbances. That is a rough, you can find exceptions to what I simplified things a bit, but to a first approximation, that's how you would describe the optimal performance or how monetary policy should be conducted. The Fed had this little problem at this point where it was all going along with this supply side thing, which was a global phenomenon. I mean, it was not just the US thing. But on top of that came, two massive fiscal, boosts that were given to the U.S. economy, because first there was just the COVID recovery plan, and then there was this big infrastructure boost, which was a total of about $3 trillion. So you might say that the U.S. economy was, after COVID, was maybe $500 billion below trend. But then when you throw in $3 trillion on top of that, now you're saying you're likely above trend. But that's a demand boost, right? I mean, people are being given checks. People are just staying at home. They're receiving these massive...
Which probably made the supply shock worse because production was not happening.
Production was not responding to, there was this massive boost in demand that happened. But this is precisely when you would think that the Fed monetary policy has to kick into action. When they're looking at the same inflation marker, you and I deal with this all the time. When we're looking at prices and quantity data, and we have to figure out whether it's demand or whether it's supply, there is often this identification issue. All we see is, one price and one quantity. And now we're trying to figure out, is that prices and quantities are moving because supply is moving or is demand moving? And both of those things were going on at this point. Once the Biden, the fiscal stimulus had kicked in, that there was a demand side. And arguably the Fed kind of stayed put, did not respond, in as much as there was a big demand side driver to the higher inflation. The Fed probably moved a little late.
Let me anchor the conversation back a little bit. So inflation targeting India.
Yeah.
So that's where we were.
Yeah, so I
think,
there's clearly been, it did two things. I think there was I'll say another thing about inflation in India. So I do think inflation targeting was a helpful thing to do. I'm not sure the target we chose as the target that the Monetary Policy Committee was supposed to be looking at was appropriate for the instrument that it has, because we are targeting headline inflation, which has a huge weight on food and fuel, which are supply side phenomena.
So headline inflation includes everything under the sun.
Everything under the sun, while all these other countries are really targeting core inflation, which strips out food and fuels from it.
But wouldn't the core and headline be very close? In terms of the weights?
Because the core doesn't have, it has food and fuel stripped out from it. It doesn't have it. But headline...
But there would be much less component in a more advanced economy.
Yeah, so that's why it doesn't move quite as separately in developed countries, because the share of food is much smaller. This is like, so in India, it's like 58%. Food plus fuel is 58%. In these richer economies, it's in the teens, most of it. So these two measures don't move quite as violently, different from each other. But here, all kinds of things move food prices. All kinds of things move, things that are exogenous to India affect gas prices, fuel prices, and all of those things are translating into massive movements in inflation. But the monetary policy MPC's toolkit involves an instrument that's really hitting demand. So you're constantly using an instrument to affect demand when the shock that is moving prices can be coming from the supply side. So it's like in some sense, you're at risk of using the wrong instrument to affect what is causing inflation to start with. So arguably...
So maybe you are using the right instrument to target the wrong.
Maybe that's semantics. I don't know. Yeah, maybe wrong instrument target the right one or the right instrument target the wrong one. Maybe. I don't know. I have to think through that. It's sort of a...
So ideally you would want to target core, which is inflation stripped out of food.
Yeah,
and fuel.
Food and fuel removed from. That would be the right way to... That would be an appropriate match of the policy instrument with the variable that you're trying to target, or the measure of inflation that you're trying to target. It's demand and demand. I mean, it's a demand-side instrument. Except with this caveat that, there is a component to inflation. Inflation is driven by inflation expectations. And inflation expectations are responding to what the MPC is announcing. So in as much as they are announcing that, we are targeting 4%, it does have an anchoring effect on inflation expectations, as opposed to the previous system that we had, where nobody was clear what was being targeted. I mean, it was a multiple indicators approach, so which basically was...
you didn't know what the policy function of the RBI is.
Yeah, we had no idea what that thing was doing. So there was clarity about what at least this Monetary Policy Committee is trying to achieve, which helps for people to form plans, to form ideas, and form expectations about what might happen going ahead. That was missing earlier. So I think that was... But I have issues with the instrument, the measure that they chose to target in the end. In terms of inflation in India, I do think the government, just because of this food interface, the government has a massive role to play in what happens in inflation, as opposed to industrial countries again. So we are somewhat distinct in the way we are because of, again, this food price. What happens to food prices in India has a lot to do with what the government is doing in terms of whether it's minimum support prices, whether it's how they're handling, FCI is handling, release of food, whether we are importing or whether we are not.
But even the fruits and vegetables, which are much more volatile in their prices.
Yeah. So, there are lots of pieces here which are outside the ambit of the RBI or the MPC, but really slam bang in the middle of what the government controls. And the government can affect much more directly. And yet that measure is what goes into headline inflation, which is what the MPC is responding to, even though it's really the government that has a more direct control over some pieces of it. And that's why there's a mismatch. And so some of the credit, I think, for inflation having come down from those gory double-digit rates that we used to have so for example, in the 2000s, I mean, we just had routinely, double-digit inflation rates, not just 2000, up until about 2010, up until 2012, until Raghu became, 2013, I think, was a bit of a state shift. And then you see inflation rates coming down. But up until that point, I mean, we were just used to double-digit inflation rates.
So there's some role of government in it as well.
Yeah, and so that's what I was going to say, that I think the government has to be applauded for having kept a lid on food prices through not giving ground on MSP, just like handing out. I haven't looked at FCI. I have to, just looking at how food prices have become less volatile over the last 7-8 years. I would think FCI is probably doing a better job than they used to. I know a lot of people don't think the FCI knows what they're doing, but at least looking at the reduced form outcome of just what food prices are doing, it seems various arms of the government are doing a better job of preventing food prices from moving the way they used to. They're still moving around, they're volatile, but nothing like what used to happen earlier. And the level of inflation of food prices are much lower than they used to be. There's still volatility, but we earlier had also volatility around a higher mean.
So we had 14% inflation, which would have
which
four,
would
five.
then volatile move around. And so we had the worst of both worlds. We had a high mean and then lots of fluctuations around that. That has, we have a lower mean. Probably the volatility is still there, but that's because it's still a very, agriculture in India still is very irrigation, rain-fed, monsoon-based irrigation. So I don't think there's, we're getting better at it, and we probably should be embracing, international trade in food more in order to stabilize this kind of
the
volatility. But certainly, I think the government should be applauded for having, a big part of our inflation stabilization. The fact that it is, it's now much stabler than it used to be, is because it's the government that really controls a large part of it, at least the headline stuff.
The headline stuff.
Yeah.
So following on this, this is not just specific to India. I was going through your research, and one of your recent papers talks about if you have inflation targeting, then your exchange rate basically moves with the price of the oil.
Oh, yeah. Yeah.
So basically you get tied, in some sense, your currency gets tied to the price of oil.
Yeah.
Maybe you can tell us about this work.
Yeah, it was actually an interesting finding. I mean, I was writing this in Canada initially. I'll just give you a little backstory to this paper. Canada in general has been a pretty diverse economy, right? I mean, it has manufacturing, but it also has, the western part of Canada has huge amounts of oil and gas. So Alberta, it relies on natural resources and so on. And then we were faced with a situation in the mid-2016 when oil prices began to go up, and the Canadian dollar just kept appreciating like crazy, and it was like it was clockwork. I mean, oil prices would go up, the Canadian dollar would appreciate. So at some point, I mean, the manufacturing guys were complaining because, that this is not just an oil economy. And the idea was that at that point, the subtext in this debate in Canada was that there was a conservative government in power whose base, the prime minister at the time, was from Alberta, which was this very, oil and gas rich province. So there was a sort of an unwritten, subtext here that somehow this was all politics. That that there were essentially it was like policies geared towards Alberta as opposed to Ontario and so on, which is much more manufacturing. So in fact, I wrote an op-ed with a colleague of mine at the time saying that this has converted Canada into a into a commodity currency, which is it's not a commodity country and so on. It is much more diverse than that. But then I kind of got interested in it and started looking at other inflation targeting, countries going back. So it collected a huge amount of data going back to 1989 and New Zealand and all the way out. And lo and behold, there's like a bizarre pattern where, countries that were previously, currencies were not responding to oil. And as soon as after they switched to inflation targeting, you had this response of the currency appreciating every time oil prices went up. So explanations, a simple one would be that when oil prices go up, it does have an impact on inflation because in as much as imported goods, in as much as oil is a big intermediate input, it starts raising.
And for most of the economies, they import.
Yeah,
right?
they import. And even if it's not, that's the opportunity cost. I mean, even if you're exporting the good, but if the world price goes up, the price at which oil will sell at home is not going to be any different unless the government is subsidizing oil at home, which most of these guys don't. So as a result, every time oil prices go up, there is an effect on inflation. So now if, as a central bank, you're an inflation targeter, you will respond by raising rates. But raising rates, in as much as it appreciates your currency, will cause an appreciating currency. So that would be the simple way of thinking through what's going on. There's another more exotic explanation, which is related to this idea that sometimes we're just missing a nominal anchor. And, inflation targeting can create indeterminacy in certain cases. So, you can have this world where things have become indeterminate, and then you use oil prices as an anchor to price the exchange rate. But that's a sort of a higher order explanation. I think the most logical one is the one I just told you.
So India doesn't have this for a very long period of time, but does it hold for India as well, or we don't know?
And India was, I think, in the sample, I can't remember, India switched very late. It was to 2016 that they changed, and I think our data just was going to 2018, which is when I did it. So I think I didn't include India. I don't remember. I don't remember whether we did it or not. But again, I mean, talking of monetary policy in India, I mean, just following it, even though it's an inflation targeting country, at least when I listen to all the monetary policy speeches that the governor makes after every monetary policy decision, they always lead off with what's going on with the real side of the economy that, they're measuring. So it almost seems like the U.S. Fed, which is, clearly has two goals. The U.S. Fed is trying to trade off inflation and, employment and, the real side and growth. That's how I hear the speeches that the MPC members make, and the debates have a huge amount of discussion on what's going on in growth, and we are trying to, balance things. That doesn't sound like an inflation targeting economy. So it's there on paper, they're supposed to deliver it, but I think maybe the way to think of it is they have a hierarchy of goals, and the inflation goal is up here. So as long as the markers are somewhat aligned with the target, they start focusing on other things, and that's why. But certainly it's not the kind of narrative that you would typically expect to hear from a strict inflation targeting central bank, which would really be talking about what are my inflation markers and where do I see this go. We spend a lot of time discussing growth. So it's doesn't sound like a sort of a pure inflation targeter. I mean,
for a weak inflation targeting, they are doing okay.
They're doing okay, yeah, absolutely. But as I said, a lot of the credit for that is the government. Yeah? I mean, it's not hand it all off to the MPC.
To the RBI, the MPC. Okay, I'll move to another part of your research work, which is also like fairly in depth, and you have been following it for a decade now. You have been tracking the productivity and income differences in India. And so one of the interesting things you have talked about is structural transformation. Maybe you can tell us what it is. And then also talk about that it has led to decline in the wage gap between rural and urban areas. So why is it important, and what does it tell us about inequality in India?
Yeah, so this one of the well-known facts of development is that as countries develop, there is a change in the industrial composition, the structural composition of the economy. That's why it's called structural transformation. That economies start off being very agrarian, and then gradually, as development kicks in, the resources begin to flow from agriculture towards manufacturing and industry. The agricultural sector's importance gradually declines, and the role of manufacturing becomes more important. And then gradually, there's a third stage where you move into services, where the economy becomes gradually much more service sector oriented. So that's called structural transformation. So India has clearly, been going through the structural transformation process with a little bit of a twist that we seemingly have jumped to stage 3 without really going through stage 2. So there has been a declining importance in terms of share of output of agriculture over the last, 30, 40 years. It hasn't been accompanied by a big increase in the share of manufacturing. What it has been accompanied by is a big increase in the share of services in the Indian economy. So in some sense, we seem to have, at least in both in terms of share of output and in terms of share of employment, service sector has been the major gainer in the last 30 years. So agriculture has been shrinking in importance, but it's the service sector. So we seem to have kind of jumped the middle stage. But nevertheless, there is this structural transformation of declining importance of agriculture. Now, if you think of this transformation from an agrarian economy to becoming a sort of a non-agrarian economy to, just pool together both services and manufacturing, just think of them as non-agrarian. The key thing is agriculture is much more, is rural. So that's a transformation which involves people, individuals actually having to change what they're doing. And that change also involves not just change what you're doing, but often changing where you do what you do. because the expanding sectors are typically urban, mostly, doesn't always have to be tier 1, but, tier 3, smaller towns. That's where the growing components of the economy are. And, so you have to change what you're doing, and you have to go to new places to do what you want to do. That's where this rural-urban becomes an important thing. So if you think about the economic structure of an economy, you have, 3 sectors, and you can do this in rural or you can do this in urban. The problem is that rural is mostly agrarian, urban is mostly non-agrarian. So if the agrarian part is shrinking, these people have to move to the urban sectors to find. So this rural-urban disparities then become like a big thing about so as the transformation is happening, you might expect that these rural-urban gaps are going to widen, because rural opportunities are disappearing, and where do these guys go? What do they do? And fact of the matter is, in India, 50% of the work, we're still very agrarian, and very rural in the sense that 50% of India, actually more, lives in rural India. It's about 60%. We haven't done a census in a while, so we're not sure of what the numbers are. But, it's
But
still,
it won't go down.
It won't go down much. And agriculture is still about 50% of the labor force, maybe 46, 47%. So it's hugely the share of people who rely on rural India and on agricultural India is massive, right? So then what has happened over these last 40 years when we've unleashed reforms?
So just to think about, in the international context, would it mean that agriculture or rural areas would have lower wages and the inequality would grow?
Yeah, so one is just the level difference. Rural areas, wages are lower, urban wages are higher. Some of that reflects higher cost of living in urban areas than rural areas, but even adjusting for that, urban wages tend to be higher. But the question is, as an economy is going through the structural transformation, does this gap widen or does it shrink? Is, I guess, the key question one wants to ask. The level gap is there, but does it shrink or does it widen? In India, it has shrunk over the last, at least since 1983, rural-urban gaps have declined. A good counterexample is China, where, during that same period, since the mid-80s to about 2010, the rest of the structural transformation is quite similar, except rural-urban gaps are widened.
So this is in terms of wages or in terms
of wages?
In terms of wages,
yeah. Also in terms of household consumption. Household consumption is a more muted effect. Wage, movements are much sharper. But it also shows up in household consumption. But, rural-urban disparities in China have actually widened. And so one story, the story I like is, in China, they've imposed all kinds of restrictions on people moving from one area to another. In particular, if you have sort of a rural passport, they call them hukou. So if you have a rural hukou of a specific province, you can't just move to an urban area within that same province, leave alone going to other provinces. So in effect, what it's doing is it's depressing labor supply to the expanding urban sector, which needs labor, but they're not getting enough. So that just bips up wages in urban sector.
And those guys are stuck in rural.
These guys are stuck, so that gap kind of widens. Whereas in India, there is no such friction. So in fact, if you're poor today, the worst affected are the urban poor, where cost of living is incredibly high, cost of shelter is very high. So a lot of them are construction workers who show up. They often sleep at the construction site. So it's pretty poor living, and they don't have the family farms to allow them to, subsistence becomes an issue. Whereas in rural areas, there's at least also Narega helps in rural areas. So it has really provided, in India today, if you're poor, this can be nothing worse than being urban poor. Rural poor are actually a bit better off than urban poor. I mean, at least that's where it's kind of
relatively speaking.
Relatively speaking, yeah.
And then following on this research, I also saw that you also did something similar based on caste.
Yeah, that was actually the first paper we'd done on caste, trying to understand, what has happened in terms of disparities across castes in India, which also came out of it was a bit of an embarrassing. I remember there was a gathering at a colleague's place, it was 13 years ago. And, over dinner, there was, one of the non-Indians. It was a very India-centric collection of people. And in conversation turned to caste, caste system in India and so on. And then there was this one non-Indian in that room who just turned around and asked, well, what has happened to these gaps over time? We keep hearing of India growing and so on. Have caste disparities declined? There have been reservations in place and so on. And we kind of looked around and nobody really knew the answer. And so it was a bit of an embarrassing moment that a whole room full of Indians, and a lot of them working on development economics, had no answer to what has happened to caste disparities in India, despite India having probably the oldest affirmative action program and on a wide scale going back to 1952. So, it's like elementary program assessment. You kind of have a program which was supposed to be temporary in nature. It was not. That was not Baba Sahib Ambedkar's, initial idea that the reservations were going to last for as many years as they have. So we should have been doing periodic assessments on, how it's working out. But as late as 2010, as late as this was 2009-10, there was nothing, in a systematic way. There would be like one pocket of a study on like some caste disparities in one mohalla in Mumbai. Somebody else would have done an anthropological study on another group in some other place. But we're talking of India-wide over a long period of time.
And economic disparity.
Economic disparities tracked over time, not just at a point in time that are there gaps. And a lot of the anthropological kind of studies, case studies that existed were really telling me that there were gaps between the scheduled castes and the Dalits and non-Dalits at a point in time. But that's not telling me whether the gaps have increased or decreased. So this is where, at some point, this non-Indian and I kind of teamed up. So this was Victoria Ratkovska, and I sort of started actually trying to look at this question in a more systematic way. And that's led to the caste paper. And we were really pleasantly surprised.
So
I was.
What's the time period for this study?
This is 1983, the first year that we have unit-level data from the NSS. We did that particular study till 2009-10, which was the round that was available at the time, the last one. I've done a follow-up paper, because that one was just documenting the facts, that there has been. So what we found there was between 1983 and 2009-10, there has been, a narrowing of, caste gaps in wages. So scheduled caste versus non-scheduled caste. That was because those identities have remained immuted because there's been this backward class versus reservations. Those have changed over the 90s. But SCs and non-SCs, that identification hasn't changed. So it's an immutable identity. So that's what we were contrasting. Wage gaps have shrunk. Consumption gaps have shrunk. Education gaps have shrunk. Employment distribution. A big narrative of caste is really that some castes are unable to transit into occupations, there is barriers to occupation mobility. Occupation distributions have become similar. And most hearteningly, we also found that intergenerational mobility, our children of SC/STs changing their occupations, changing their education status, improving their wages relative to their parents at a faster rate than non-SCS children. And it was like, intergenerational mobility was actually faster amongst SCSTs, has been during this period. So then I've done a follow-up paper now. So that was all about just facts. Those are just plain facts. And then there's a follow-up paper now which is trying to explain it. And what we say is that, what I find is that just productivity changes can explain a lot of it, because some sectors were growing and its education was the main driver, and a lot of self-selection into greater education, to higher education.
So if you have to rank order, would reservation play some role?
No, reservation really it doesn't play much, because it didn't really change. The reservations have always been there, pre and post 1983. It was there from 1952. What has changed is the growth rate. It's which has created a massive demand for labor of a certain skill set, and that has created demand for education. And that is it's like this education that is the major driver of all of this catch-up, because SC/STs have been increasing their education attainment rates at a really fast pace relative to the others. And that has been the source of the catch-up, which I think is because that's a policy actionable thing. that, which is education-based. That's the major driver. Now, coming to that other question you asked, which is about what does this tell me about inequality in India? So inequality you can think of as a two-dimensional thing. This discussion of rural-urban, SCSTs, non-SCSTs, this is really about intergroup inequality. And so both these pieces of work, research that I've done basically are suggesting that intergroup inequality has narrowed in India. But then there's another source of inequality, which is within group, that within group inequality. So, there are ways of, so since you do a lot of statistical work, I know. So, if you have a Thiel index is very nice because you can essentially decompose inequality into these two pieces, and it's additive. You can add them up. So you have a within group component and a between group component. And then you can ask, which one is the main driver of inequality? So I think the Indian story really is within group inequality possibly has widened, but between group inequality has shrunk. And my research work has mostly been on this between group. But I think within group inequality has possibly...
So it opens up a lot of questions on how we think about the resolution.
How we think of, yeah, exactly, yeah.
Okay. That was perfect. It was great talking to you.
Well, it was lovely. Yeah, thanks for having me. It was a pleasure. And it's good to see you as always. Yeah.
Thank you. Okay.